Hello everyone. Yeah, in today's lesson, we are going to see now the part 2 of our previous lesson, which was the provision for depreciation of non-current asset. Now we are going to see what happens when an asset is being sold, when disposed of. So quickly, let's see what are the entries to be made. When a non-current asset is sold, the following entries are required. First of all, understand that you have to open a disposal account. This disposal account is the one which is going to show you whether you have made a profit or a loss on disposal. When an asset is sold at more than its net book value, then you have made a profit. If it is sold at less than its net book value, you've made a loss. So the disposal account, as you are closing it, will show you where the entry should be, whether on the debit side of the income statement or credit side of the income statement. Remember, debit side of income statement, it means you're recording as a loss, while credit side you're recording as an income, right? Now, the first entry is to remove the asset from the remaining assets. So that means, you remember an asset account has a debit balance, right? So if you are removing it, you credit that asset account and you debit disposal. Remember, all entries are done with the disposal account. So I repeat, asset has a balance brought down, an asset account has a balance brought down the debit side. So if you are removing it from the asset which is sold, you are removing from other asset, you have to credit the asset account and you debit disposal account, right? So now the next step now is to also remove the accumulated depreciation of the asset which is sold, right? So you cannot keep on maintaining the depreciation of an asset which is no longer existing in the business, right? Now remember, the provision for depreciation has a balance brought down on the credit side, right? Because you credit normally provision for depreciation and you debit income statement when you're recording depreciation. So the balance brought down of the provision for depreciation is always on the credit side. So now to cancel the depreciation, you now debit provision for depreciation and of course you credit disposal. Then the next step is now to record the sale. To record the sale is now to look at the amount at which the asset has been sold, and if the asset has been sold this much and this has been paid by bank or cash, obviously you debit bank or cash and credit again disposal account. Like I said, all the entries are done using the disposal account, right? Okay. Now, before now, balancing of the disposal account, it's very important to remember that the asset which has been sold, it has to be depreciated until the date it is being sold. So you have to calculate the depreciation of the asset which is sold from the beginning of the year until the date it is being sold. So obviously, you will debit income statement and the credit provision for depreciation, and then you can balance off the disposal account so that you can transfer the balance in the income statement either as an expense or as an income, right? Then you have to balance off the remaining accounts, meaning the asset account, the provision for depreciation account. The disposal account will be closed. So after looking at these entries, we're now going to look at an example, and I think the best way you can do is just use it straight away in a past exam paper so that you understand better. I just quickly recall what I've just said. When you are removing the asset from the other asset, you credit the asset account and you debit disposal, because the asset account has a balance brought down the debit side. Then we are removing depreciation of the sold asset, accumulated depreciation. Remember, depreciation, provision for depreciation has a balance brought down on the credit side. Then you debit it to remove and you credit disposal. To record the sales, debit the bank or cash and credit disposal. and then you record the depreciation of the asset which is sold until the date of sale, and then you actually, in that case, you debit income statement and credit provision for depreciation, and you balance off the disposal account, and you close the remaining account, meaning the asset account and the provision for depreciation account. Here is an example. We have an extract from JAS statement of financial position at the 31st December 2019, which showed the following, right? So we have the fixtures, the cost, accumulated depreciation, and the net book value. In other words, these are the balances brought down in the fixtures account, that is on the debit side, and accumulated depreciation will be on the credit side, because this is the balance brought down of the provision for depreciation. This one will be balance brought down on the credit side. And now, during the year ended 31st December, the following transaction took place. On 1st January, please remember this year ended on 31st December 2019, which means it started on 1st January 2020, right? So the very same 1st January 2020, other fixtures were purchased by check. Now, in the middle of the year, on 30th June 2020, fixtures were sold for 6,000. This is the sale, which was received by check. These fixtures had originally been purchased on 1st July 2018 for 20,000. You are given this date so that you can be able to calculate the accumulated depreciation. So at the time you will be cancelling the asset, removing the asset and removing depreciation, you have to calculate the depreciation from the 1st January 2018 till the date the asset is sold, that is on 30th June 2020. Right? Now, just depreciate fixtures on straight line basis. She assumes that fixtures will have a useful life of 4 years, at which time the residual value will be 10% of original cost, which simply means to calculate the depreciation for the year is to take the cost minus 10% of the cost divided by 4, right? Then depreciation is charged for each part of the year for which the fixtures are owned. This information is very important because it shows you whether the depreciation is taking place for the whole period the asset is held in the business. Sometimes they can tell you that there is a depreciation there of purchase, none in the year of sale, or vice versa. So now we know that the depreciation is charged for each part of the year for which the assets are owned. Now we are asked to prepare fixtures account, provision for depreciation account, as well as fixtures and disposal account, and you have to show the working where it's possible, right? So before we actually look at the entries, I want you to take a few seconds and go through, read again the question, and then we're going to see in a moment how we solve the question. Now, like I said, fixtures and fittings account, six fixtures account, the 115,000 is the balance brought down, right? And then in the provision for depreciation, the 77,625 is the balance brought down, meaning these are the depreciation which have been calculated so far by January 1st, 2020. Now, what do we need? We need to understand that on 1st January 2020, they purchased other fixtures. So what do we do? Obviously, if you purchased other fixtures, we're going to debit fixtures account and credit bank 30,000. So on 1st January, this is January 1st, this will be bank account, and it's how much again? it's 30,000, right? So 30,000 will be debited in the fixtures account, right? Now, here now we are on 30th June. On 30th June, that's when a sale took place. Now, for this, we are going to look at those steps. We are going to remove the asset which is sold, remove the accumulated depreciation, record the sale, and balance off the disposal account, right? All the steps that we're looking at in our previous in our PowerPoint presentation. So we are going to remove the remaining the asset from the other assets, the sold asset, meaning the fixtures, and we also remove the depreciation of the sold asset. So let's go. What is the cost of the asset which is sold? The asset which is sold cost 20,000. So we have to remove this asset from other fixtures. So what do? We'll simply credit fixtures account. Remove the cost. We always remove the asset on cost. So 20,000. And like I said, we always use the disposal account. So that means the 20,000 will be debited here in the disposal account. All right. So if I debit disposal here in the detail, I'll show the account which is a crediting, right? So the account which I'm crediting is fixtures. So and the account that I'm debiting is disposal. So here I'll write the disposal, right? And the date. The date is on 30th June 2020. So this is June 30th, 2020, right? And here in the disposal account, this one will be fixtures, and on June 30th, 2020. So I'm done with the first step. Which first step? I have removed the fixtures from other fixtures account. So the account for fixtures had 115,000. Some more worth 30,000 were purchased, but 20,000 were removed. So the first step is to remove the sold fixtures from the other fixtures by creating fixtures account and debiting disposal. Now I'm going to go to the step 2, which is the step 2. The step 2, it says we have also to remove the accumulated depreciation of the sold asset, right? So you have to calculate the depreciation of the asset which is sold. This asset was purchased on 1st January 2018 and it was sold on 30th June 2020. So that means the whole year of 2018, yes, 2019, and 2020 only for 6 months. So we are talking about in the whole of 2018, the whole of 2019, and 2020 we only calculate for 6 months because it was sold at the end of the month of June, meaning in the middle of the year. So now the depreciation is actually the cost. How do you calculate depreciation? We are told that its residual value is 10% of original cost, right? The depreciation fixture on straight line method, fixtures will have a useful life of 4 years, at which time the residual value will be 10% of original cost. That is how we're calculating the depreciation. So now our cost here is 20,000 minus 10% of 20,000, because that's what they are saying, to calculate the depreciation, divided by the number of year, which is 4. This is the calculation of 1 year depreciation according to the specification we are given in the question paper, right? Why? I repeat, They are telling us that they will have a useful life of 4 years, at which the residual value will be 10% of original cost. So that's what I did there. Right, so if I work out that, it's actually giving me 4,500. So 4,500 is the depreciation for 1 year for that sold asset. Now, we had it in the business for 2 years and a half. Second year again is the 4,500. And the third year is actually the half of 4,500, which is 2,250. So this is the total depreciation of the asset which is sold. So if we take 4,500 plus 4,500 plus 2,250, my answer is 11,250. This is the total depreciation of the asset which is sold, and we have to remove this depreciation from the asset which is sold. So what do we do? Again, you remember the provision for depreciation of the fixtures? It's 77,250, and we have to remove 11,000. I think it's 250. 11,250, and we transfer this in the disposal account. Okay. Still, we are doing this on 30th June 2020. So we go to the disposal account. So we debit provision for depreciation to remove. You remember I told you provision for depreciation will have a balance brought down the credit side. So to remove it means we debit here and then we credit in the disposal account. 11,250, and this will be provision for depreciation. 30th June 2020. Right, so on the same date, we are now going to record the sale. Right? It was sold for 60,000. We are following the steps. This is the third step. Now we have actually removed the asset from the other fixtures. It's fixture from other fixtures. We have removed the accumulated depreciation, and now we are going to record the sale. So the sale is 60,000. How do you record the sale? It's by check. So we debit bank or cash. Here it's bank because it was sold by check, and we credit disposal. That's what we say, that all the entries are done using the disposal account. So 6,000 will be here, and this will be bank, and this again, that's still on 30th June. Right, now another important step is now we have reached now the end of the year on 31st December, and we still have to show the depreciation of the remaining asset. Remember our asset, right? We had an asset which cost the original asset, right? We have original asset here. Just let me erase a bit. Right, so we have an asset which cost 115,000. That was the balance brought down of the asset account, and we have sold asset worth 20,000. These are original assets we have, which means the balance we have for the asset is 95,000, right? And then we have purchased. Remember, we have purchased other asset worth 30,000. All right. So this 30,000 also needs to be depreciated. The asset which cost 30,000 we also need to be depreciated. And then we have sold asset which cost 20,000, and we stayed with this for 60 months. Right? Now remember, the depreciation is the cost minus 10% of the cost, which is 9,500 here, divided by 4. For these ones also, we'll take 30,000 minus 3,000 divided by 4. And for this one also, we'll take 20,000 times 2,000 divided by 4. I repeat, because we are told that to calculate the depreciation, we take the cost minus 10% of the cost divided by 4. Right? So now, if we work out this, right, 95,000, take our calculator, work out 95,000 minus 9,500, I get 85,500 divided by 4. The answer here I'm getting is 21,000. Sorry, it's 20 for the first ones here is 21,375. For the second ones, 30,000 minus 3,000 divided by 4 is giving me 60,750. And the third one, these are the assets which we sold, but we have actually stayed with them for 6 months. So 20,000 minus 2,000, 10% of the cost, divided by 4, right? And the answer we get, we divide by 2, right? Because it's 60 months. So it means 4,500 divided by 2, right? So which will give me 2,250. These are the figures for depreciation for the year. It's a bit complicated, but I want you to understand that we have reached the end of the year and we have to depreciate all our assets. So to depreciate our assets is to take the cost, like for original asset we had, the cost is 95,000 minus 10% of that divided by 4. I'm sorry, the handwriting is not very clear. Right. So the second asset is 30,000, the new asset we purchased, minus 10% of that divided by 4. The third ones are the ones that we have sold, and we have to calculate the depreciation from the beginning of the year until the date they are sold. And that's why you take 20,000 minus 2,000 divided by 4. All these have to be credited to the income statement and debited. Have to be credited to the provision for depreciation and debited to the income statement. Right? Remember, please, that when we are depreciating our assets, we have to transfer the depreciation to the income statement. So on 31st December 2020, we have to transfer this amount to the income statement, mainly 21,750 and 375, sorry, 31,375. All right, these are all the first asset. The second one was 6,750, and the third one is 2,250. All these have to be transferred to the income statement, right? And we say the total of all the assets is 21,375 plus 2,250 plus 6,750. It's 30,375. So 375. 375 is the total depreciation for the year, right? So now, after recording in the income statement, what is now remaining is now to balance off all the accounts. Remember that the provision for, the fixtures and disposal account, the difference will be transferred to the income statement. Now, if we have to debit income statement, it means we have made a loss on disposal. If we have to credit income statement, it means we have made a profit on disposal, meaning the asset has been sold at more than its net book value, right? So if you try to balance off this account, the disposal account, so we'll take 11,250 plus 60,000. Then we take away from 20,000. The answer is 2,750, and there is a shortage on the credit side. 2,750 is what will go to the income statement on 31st December. Remember, in this case, we are going to debit income statement, which simply means that we have made a loss on disposal. You can prove that fixtures cost 20,000, provision for depreciation is 11,250, right? So if you can see, the net book value is actually much more than the 60,000 for which I have sold the asset, right? So the difference will go to the income statement as an expense because we have made a loss on disposal. Then we just add both sides to close the account. So this account, disposal account, does not have any balance brought down because the asset has actually been sold. I mean, the difference has been transferred to the income statement as an income or as an expense. So then we can also balance off normal way our provision for depreciation account. All right. You can see on the credit side we have 77,625 plus 30,375, and we take away from 11,250. So we have a balance carried down here on 31st December. We have a balance carried down of 96,750. These are the value of our asset at the end of the year. So if we add now both sides to close the account, it's okay, 108,000. So 108, and we bring down the balance on 1st January 2021. There will be a balance brought down. Please remember, try the balance in full. That's what IGCSE doesn't recognize these abbreviations. And the balance brought down will be, of course, 96,750, which means our assets, fixtures at the beginning of the 2021 will have a balance brought down of 96,700. Provision for depreciation will balance brought down will be having 96,750. And our asset, which is a fixtures asset, we also have to find the balance carried down and the balance brought down. So plus 30,000 minus 20,000. So here we have a balance carried down of 125,000. Remember, this is 31st December, and we add both sides. So this is going to give us 145,000, and bring down the balance on January 1st, 2021. Balance brought down 125,000. All right. So we have actually balanced off all the accounts, and we are done. Okay. Right. So you need to go through quite a number of these type of questions. By the end of the lesson, I'll give you some summary of the question paper you can try for you to understand better. But let's have a look at some multiple choice questions as well. Right, here's a question, a multiple choice question. A machine which had cost 6,290. Right, this actually taken from summer 2021, question paper 11. Right, so machinery which had cost 6,250 was sold for 3,100. The disposal account showed a profit on disposal of 584. How much was the depreciation up to date on disposal, and which side of the disposal account was it recorded? So here we have the cost of 6,290, and which was sold at 3,100. So if we take the selling price, which is 3,100, and there was a profit of 5,584. If we take the selling price minus the profit, we'll definitely know the net book value. So the net book value of this asset is, of course, if it was sold for 3,100 and at a profit of 584, which means the net book value is supposed to be 2,516. Now, if you want to calculate the depreciation now, we take the cost minus the net book value, because the cost minus depreciation gives you normally the net book value. So if the cost is 6,290 minus 2,516, right? So 6,290. The answer I'm getting is 3,774. 3,774. So the question is, and on which side of the disposal account was it recorded? So remember, when you are cancelling the depreciation, when I remove the depreciation, you debit provision for depreciation and you credit the disposal account. So it will be recorded on the credit side of the disposal account. Right, here's another interesting one. It's extracted from March 22, QP12. Abel prepares financial statements to 31st December each year. Abel bought machinery for 40,000 on 1st January year 1. He charges depreciation on machinery at 20% per annum using reducing balance method. Depreciation charged in the year of purchase, none in the year of disposal. So here, if this information is very important, that means in the year of disposal, no depreciation. Now, on 1st January year 3, the machinery was sold for 2,000, 22,000. So in the year 3, which means you have to look at the depreciation for year 1 and year 2 only. So then they are asked which journal entry recorded the profit or loss on disposal. So here the question is, the cost was 40,000 and the depreciation is 20%, right? So 40, okay, let me do it here nicely. So 40,000 times 20%, the depreciation for year 1 is 8,000, right? 8,000, which means the net book value is 32,000. Second depreciation is 32,000 times 20 over 100. So 32,000 times 20 over 100, which is 6,400. So the net book value is 32,000 minus 6,000. 32,000 minus 6,400, which is 25,600. And we are told that it was sold for 22,000. Definitely. This is the net book value. And it was sold at less than the net book value. So there was a loss. Isn't it? So the loss is actually the difference. Right? The loss is the difference between 25,600 and 22,000. So the loss is 3,600. So if it is a loss, obviously, if you are recording the loss, we debit the income statement and we credit disposal account, isn't it? Remember, that means we are actually transferring the loss into the income statement as we are balancing off the disposal account. So we'll debit the income statement and we credit disposal account. Right? Yes. So these are the two questions. Right. So let's look at again another question. Here this is summer 19 QP11. Rick started a business on 1st January 2017 and purchased machine costing 18,000. decide to depreciate the machine at 20% per annum using reducing balance method. No depreciation charged in the year of disposal. Machine was sold on for 13,300 on 1st July 2018. So understand the dates here, right? Understanding the dates is very important. So if the year started on 1st January 2017, it means it ended 31st December 2017. And the second year, that's when the machine was sold. And we are told that no depreciation in the year of disposal, meaning the depreciation we need to calculate is only for 1 year. So it's 18,000 times 20%, right? So which is 3,600, right? So 18,000 times 20% is 3,600. Now the notebook value is, of course, 18,000 minus 3,600, which is 14,400. Now we have sold it at 13,300. Again, is another loss. So if we take away from 13,300, we get a loss of 14,400 minus 13,300, a loss of 1,100. So the answer is A, loss of 1,100. Right. Right. So some of these questions can be actually helpful when you'll be doing trying to do different exercises. Please do not hesitate to go through the provision for depreciation, and all these questions you can go through them, and they will be very helpful for your preparation. Thank you very much. I hope we have actually had nice time to discuss the provision for depreciation and disposal. Don't forget to put your comment and to like, as well as to subscribe. Thank you very much. Bye.